Hey there, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. This is Blockhead Traders for the week of August 3rd, 2025. In this week's episode, I'm joined by fellow Blockhead trader viperxl007, and to be honest, we didn't really prepare much for this episode, so we're going to do it live. And we're just going to recap a little bit about what we did this trading week. And honestly, it might be pretty short because it is so hot and so humid at both of our locations. It's absolutely miserable everywhere. So, you know, we'll hop to it. But before we hop to that, I want to give a shout out to our Discord, link in the description below. You can hop in there, say hello to myself, Viper, some of the other Blockhead traders. Love to hear what you're trading. Love to hear what type of content you want to hear about. Also, you'll find a link to thetagang.com/sprocket888 as well as /viperxl007, where we post each and every one of our equity trades, the good, the bad, and the ugly. Last, this is available in an audio-only format wherever you get your podcasts. So look us up, subscribe, and if you can't find it there, let us know and we will get it there. But let's hop to this week's content. Viper, it has been just a crazy week for me. Just a lot going on outside of work and everything with just life. So honestly, I did not get a ton of time to prepare for this. And the weather, I don't know, when it gets just hot and humid, my body just kind of shuts down or just moves in slow motion. It's so miserable around here. I think you same for you. You live further in the south than me, but I don't think you'd know it by looking at the weather or anything at these days.
Yeah, these are I call them cave days. We obviously get them a lot more often. And basically, I crank the AC, I shut all the blinds, I shut all the curtains, and just pretend like it doesn't exist outside.
Yes. You know, well, at least I did, and I think you had a little bit of a nice distraction because this week earnings really, really took off. And I thought, you know, I'd just touch on a little bit about what I did in the market this particular week. I don't have any fancy charts to show or any of the Flappy Bird charts, so I'll just kind of talk through verbally on some of them. You know, you can hop into the Discord as I do regularly post each week what earnings trades I'm looking at taking. I drop that in there and I go through my screener and I just say, hey, FYI, these are the earnings trades I'm looking at. I'm very mechanical these days, and on Monday morning I will hop into the market around lunchtime, maybe late morning, and I'll place the trades that I targeted over the weekend for all the earnings this week. And then I just kind of wait each day for the earnings to hit, and then I take a look at where they are, and I decide whether or not to close them out or let them ride a little bit longer into the week. So, I mean, so far we've had 4 earnings trades. At least I have had 4 earnings trades hit. There were some tonight, but we don't really know, you know, how the market will open on them. But so far, of the 4, 2 have closed out for about 90% profit. 2 of them are on the way to profit as of close today. I probably should have closed them out, but I was just too busy today to really hop to it. So, you know, I'll be looking to probably close them out tomorrow. In all of these cases, except for one, I did play Hog, which is Harley Davidson. That one it was really ripe for volatility. This is one where if you go to last week's episode, I talk about my screener, I talk about my trade that I put on. I almost always do strangles. And then what ends up happening is either we hit it perfectly down the middle and I close it out for a pure winner, like huge winner, or it comes really close to one of the strikes and I end up breaching or rolling that strike out to the next monthly expiration and end up making that for a profit. However, one of the things I do look at before I put the trade on, and this is one of the enhancements that I came to over the years, particularly through this show, is looking at the price action. And the price action on Harley Davidson looked very, very, very bullish. And so a lot of my earnings trades, when I put strangles on, I'll do like a 16 delta strangle, 16 to 18 delta. And because I put that on the bottom side and the top side, I basically need it to stay between that. So I'm really looking at, you kind of have to add those deltas together to get your kind of risk. And so I'm really looking at a 32 to 38 delta risk. So if I decide not to play a strangle and I play the earnings directionally, I will then just bump up the delta and take a 30 to 40 delta strike to play the earnings with direction. You still win if it doesn't move much, and you lose less if it moves against you. And so Harley Davidson was one of the ones that I decided to only play directionally bullish. So I only sold puts, and I basically sold about a 38 delta put on that. And that thing took off after the earnings. I think it was up 15%. It was outside the expected move. And the options I was able to close out for 5 cents. I think I sold them for around $2. And so that was just a boom. By 10 a.m. the next day, that was at 5 cents. And there's no reason to leave that risk on the table. You pay your 5 cents and you make your $1.95. And I was able to do that with, I don't know, 17 contracts or something like that. It was one that I was able to crank a good bit out on. The other ones were just typical strangles. So I put a strangle in on Etsy. That was one that just went nowhere after earnings. Really, it was just a maybe 2% move, something like that. I think the expected move was close to 10%. So those options were below 10 cents to close out the following day. And so again, that was like a 90%, 87% profit capture on that one. So those are my two just boom winners. The other two challenged the put strike on both. It was Spotify and United Health. So Spot and UNH. And those dropped down considerably. They went outside their expected move. But like I've talked about in past episodes, there is elasticity to those price actions. So both of those have now climbed back above my put strike and are really probably appropriate to close, because a lot of times what will happen with that elasticity is you'll get a rapid pullback and rise, but you might quickly get a dive off the next cliff. And that's just one of the things that I've observed over the years of doing this, is that elasticity of the move. Even if it is overstretched, there will be a quick kind of snap back. Now, sometimes it might continue up and be kind of pull back for a while. Sometimes it just might be for a few days. But anyway, that was really my excitement. I still have, I think, 5 other trades on this week. I feel I put a lot on this week. It was a very, very healthy week of earnings. And so far, I'm 50%, 100% locked in, and the other 2 are tracking good. We'll see how the rest of the week pans out. But Viper, what have you dabbled in? I know this is the first earnings trade that you've kind of gotten back to a different broker on. I don't know if it's too early for some feedback on the liquidity there, or if you've been up to other things.
So, correct. This is there's a few things I want to unpack. But yes, I'm on the new broker with this first earnings season. This is the first major earnings season on this new broker. And one of the things I'm going to go over in just a minute is, I was really like, I don't even know if I still want to do this, specifically this strategy, this calendar call earnings strategy, because man, it was rough coming out of last earnings season. Last earnings season went great, and we'll go into some details about that. Then the middle zone went really, really poorly for some specific reasons that I'll get into. But because of that, like, it was just this mental struggle of like, I don't know if this is even working, because I was continually digesting what happened. Why did my account blow up the way it did? Not in a good way. And I know I had multiple conversations with you over that time period as well, as far as like, man, I don't know if I'm doing this right, if it's working. But the ultimate conclusion was, okay, there was a lot happening, and the reason I'm kind of belaboring this point is, I think it's important, like everything I talk about or everything we talk about as far as learning out in the open and whatnot, that this is what it looks like. It's, getting in there. I don't want to say making mistakes, but just getting results. Results can be good or bad, but getting results, digesting it, unpacking it, figuring it out. and then finding a path forward with those lessons learned. And so what I ultimately concluded was big earnings season happening right now. Started last week, really sending this week. And so I was like, all right, I need to at least put those lessons learned from last earnings season and from the in-between range. And let's at least give this one more honest shake, putting all of that stuff together to try to see some improvement on the execution and on the strategy, and cut some pieces of the strategy go that just weren't working. So that's where I'm at. Liquidity wise, I've noticed it. I think I've noticed it be better, but it's still, there's still tickers where, like, I don't know, and this never happened, and maybe this is because, like we talked about previously, Robinhood can play games with the order book and whatnot. But I'm curious if you've ever had it happen where I'm looking at like a spread. I have the spread put into the broker, and then the pricing spread is super erratic, where it'll be super wide, and this is like midday, like power hour, 1-2 o'clock, so it's not like before open or anything like that. And the pricing spread will look super bad. It'll look really wide, like let's say a $2.50 price, and the spread is like $1.60 to $3.40 or something crazy. And then it just kind of starts snapping around, and it'll actually tighten really tight. And I'll get like, let's just keep it at 250 there, and all of a sudden it'll be like 220 to 280 or something like that. And so it kind of jumps around a lot. So I don't know if that's normal or if that's, I mean, I'm not going to blame this broker. Like it could just be the underlying. But
so when you talk about the spread, are you talking about the spread on your calendar, or are you talking about the spread on an individual contract?
On the calendar. So the cost of the calendar as a whole, and then the pricing spread of that whole calendar together.
Yeah. So I'll say I have noticed that. Now I don't do calendars, but when I roll a position, that is effectively a calendar spread that I'm kind of doing, because I'm, buying the front month to close and selling the long month to open. And so kind of in a way that's like a calendar order. Because typically I am keeping the same strike. I'm just kind of rolling it out. Now I have one position open, so it's closing, which is why it's not really a calendar, because it kind of erases that front month. But from an order perspective, it is. And I have noticed, depending on the ticker, you can get really weird spreads on that combination.
Okay. So, and so at first, and I this is part of what I'll continue to evolve here as I keep going. So at first I was like, nope, PTSD, I guess I'm not taking this trade. I'm moving on, delete it. And I forget the ticker, but one of the tickers I came back to, and all of a sudden I was like, whoa, no, this looks great. Like the pricing spread was super tight. So I took it. But one of the things that I noticed that was a new experience to this new broker. So back on Robinhood, if I had a really wide spread, it was so hard to get filled unless I, continually worked against my benefit, and kept bidding higher and higher on the debit, and then eventually I would get filled. So I did notice that on the one ticker that I saw the wide spread, but I really wanted it. I moved my price in my favor. And I ticked it down. So again, let's just say it was the 250 mid. And so I took it, and say the bad spread was like $1.60. So I took it down to like 220, and I was like, let's crank this down below mid and just start bidding there, and thinking I was going to have to bid up, and like it instantly filled. And so that was a good sign that it's, like you said, kind of some sort of anomaly or pricing or whatever, that it's still, I worked in my favor and got an instant fill. There's been other times where I've put a bid in. So again, let's say 250 mid, and let's say I drove it up and was like, nah, I just really want in. So I put a 270 order, and then I noticed that was my limit, but my actual fill price was, let's say, 251. So, I still got a much better price on the actual fill, even though my limit was a lot higher. So I have noticed little things like that, which are very positive experiences.
Oh, that's good. That's good.
So, let's look at a couple of things that I've done and kind of go over the bad. Yeah, let's take a look at the bad first. So if we hop over here to my statistics here, this is from my dashboard that I made, and let me square this up. So we can see pretty much all of the trades in this chart here. I'm 54 trades deep, which is we're getting there on the statistics and having some meaningful amount of data collected. So 54 trades taken. The P&L chart is not what you want to see with a 57% win rate, where the P&L chart, we talked about this on a previous episode. Things were going very well back here. So this rise up here was the last major earnings season. And then we started dipping down, and then this big drop off here is what I'll get into in just a second. And so now on this bottom part here, we're starting to rise up again. So that's good to see. I'm optimistic for several reasons on this new rise up. But real quick, I wanted to talk about what happened here. So from July 17th down to July 27th, there were a number of things that happened which were significant lessons learned with this strategy. So again, I'm deploying the calendar call, the calendar spread strategy. I have that short month that we talk about and the long month. And in the beginning of this strategy, I was taking 45, sometimes even 60 days to expiration on the long month. And so May, mid-May. So I had a lot of spreads on this early run up here, where my long month was actually, I think it was a July 18th expiration or somewhere around there. And that was like my 60-day spreads that I was taking. So we had this run up here because there were some really good trades in there, but because of how I was deploying this strategy, I was just kind of letting these positions linger far beyond the useful capture of the volatility crush. And so what I mean by that is if the volatility crushed on the short month and the short month expired worthless, but the overall underlying was down and I was, that long month was in a loss, I was like, we'll just hang on to it. And like we talked about before, now I have this reduced lottery ticket price on this long option for the back month. And so let's just see, I got 60 days to figure it out. And guess what? Those checks come due. I mean, they don't come due per se. They're paid for, but old Captain Time, old Father Time and Father Theta kicks in, and those things just evaporate. So this big drop off here was basically the clearing of the books. So this was all of the bad trades, which was, there were like four really bad ones, compared to like 12 winners that I had. But the really bad, this is where the calendar spread gets completely broken, because I held on to the long, the short expired worthless. But as soon as I decide to hang on to that long, I'm completely breaking the risk profile, because now I have the potential to lose the entire amount that I paid for that long, which is exactly what happened here. So, so that was one of the big lessons learned of execution on this strategy is we're not going to play that game. We're not, this is a package deal. The calendar spread, we come up on the week of expiration for the short, and we just close the whole thing out, and we don't leave any of these lingering long options or anything like that. Maybe in some really rare Conviction cases. There was a quantum computing stock that did really well with that, but that's still outside this strategy. So that is what happened there. And so what I've done since then is, like I said, I'm now approaching every single earnings trade this earnings season as a package deal. So there will be no holding on to the long expiration. Another thing I started doing that you and I talked about, Sprocket, was instead of using weeklies in anywhere in my spread, except the next available expiration for the short month, the long month will always be anchored to a monthly, because I have seen that make a big difference in the spread cost and the pricing spread. And so I'm playing around with some nuanced rule sets around that. But anchoring it to the monthly option is certainly showing some really good promise. And so hopping over to this chart real quick, this was actually, before I do that, let me just show just kind of what I'm eyeing at right now as far as my active trades. Actually, my trade ideas is the trade idea tab here is probably better. So because I want to showcase why, whatever your strategy is, have your edge metric. And we talk about that in both of our strategies. There's some overlap and whatnot, but one of the things that is becoming a very clear edge metric for my strategy, as we've talked about before, but it's really rearing its beautiful head in this earnings season, is the term structure slope, which again is measuring the slope of the line from the short month option to the long month option. And the steeper that slope is, the more volatility will crush out post earnings event. And so you can see here, these are some trades that I have coming up tomorrow. So I haven't taken these yet, but these are on deck for tomorrow's open, tomorrow midday or something, or towards the end of the day, I'll start looking. For example, Reddit here. Reddit, I'm not saying I'm taking this trade just yet. There's a final go, no go that I go through a checklist just before taking these, but Reddit really jumps out here because the term structure slope is ridiculous. Negative 0.3 is the slope. And for context, the number is green if it's better than, or more negative than negative 0.004. So this is a massive, almost 10x on the threshold.
Whoa. What's going on with Reddit?
I don't know. Dang. I mean, it could be weird pricing because we're after hours, so we'll see if it holds up.
Okay.
But I mean, some of them, like Apple, is a little more normal at 0.009, so it'll probably peak to 0.1. So this could be real. So I'm going to keep a close eye on this tomorrow. The IVRV is not as high as I would like it, but that might be benefited here to the 0.3 slope. And then obviously, like I've talked about before, I run my Monte Carlo with those numbers. For Reddit here, it's showing an 84.98% probability of profit with an expected return of 30%. I haven't held these numbers perfectly to account yet, but they are at least, as far as the expected return, I haven't been tracking too closely if I hit near that. Right now, I'm just focused on win or loss, and I'm focusing on these higher 80s probabilities of profits plays. So why is the term structure slope so important that it's the thing I always talk about? Well, over here on SOFI is the quintessential example of that term structure slope importance and why it is such a key edge to my strategy. So here we had 2150 was my strike for my calendar spread. You can see earnings happened here in the green vertical dotted line here, and this thing just absolutely erupted And if I get the measure stick out here from close, so from when I opened it to open the next day, this thing was up almost 20%. So this was a pretty significant loser on open for me. And I was like, ah, crap, here we go again. Like this just, it was so wild. I think the estimated move on this was like 11 or 12%, which was still high, but 20%, come on, man. So anyways, I let it go. One of the things that I cut from the strategy, and it was part of the strategy that somebody else was doing, which, like I said, where I learned this strategy from, was the strategy was open 15 minutes before market close the trade 15 minutes after market open, no questions about it, rigid, bing, 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 bing. And that just flat out was not working for me at all. And some of that is probably because for that to actually work, this was probably overselling the strategy where, okay, for that to work, you need to have the filter that I have, which is cool. I have that. But you need to take every single thing the filter calls out as a high probability in order for that open and close strict rigidness to work. And that's just not, I'm not doing that. So I did not close this 15 minutes after open. I was like, well, we're in it now, super deep in the money. Let's just see where things go. And then by midday here, almost around noon, actually, no, this one I waited till the afternoon. As it started cooling off, I was like, okay, that's the elasticity that you were talking about, where we had this 20% move. Surely we're going to have some mean reversion. And so as it started cooling off, I was like, all right, that's fine. Let's wait and see how this thing plays out. And it was somewhere around these candles here, which is, 1 o'clock, 1 or 2 o'clock, that I was pretty healthily in profit. And so I ended up closing this thing out for a 50% profit. And so tying this back to that term structure slope, what was so crazy about where I closed this is from my entry, where I priced and where I took my debit to open the spread, we were still 12% away from the price when I took entry, and some 9 or 10% away from my strike, 9 or 10% in the money. And why this is so, I don't know, crazy is probably not the right word, but why this is so encouraging to me is we're talking about a strategy. We're talking about a spread, the calendar spread, where it is pretty strict. Down the middle is the only way to make money. And so the reason that this made money was that down the middle was expanded because of that term structure slope, because that short month was so elevated that it crushed so hard that it took that down the middle channel and it blew it out and made it much wider, made the profit zone wider. That was the best one of the week. But I mean, Etsy was another one I did, which had something similar. The move was not as drastic, but I still went deep in the money, and that thing came back and almost kissed my strike. So I got out of that thing in a really good profit. PayPal is the only one that was just total loser. I think I ended up taking 60% loss on it, something to that effect. Or no, it's probably going to creep up to 100% because this one wasn't super expensive. It was like 55 cents. So part of this one, there was a lesson in whether or not I should have even taken it. But you can see that this one we ran out of the money. And it's going nowhere fast. So those are just going to die. So that was mostly where my earnings trades have been. I won't go too deep into it. The other trades I've been doing were my daily SPY trades. Those have actually been going very well. We'll probably do more of a dig into that later. But just on the numbers front, the SPY trades are, I've taken 9 of them so far. So if I scroll down here, I've taken 9 of them and have a 66% win rate and a nice little profitable P&L on this. This strategy is a maximum profit of around $30 to $50 per contract maximum. And I tend to bail out at around $20 to $30 loss on it. So this is meant to be what I'd call an income strategy, which is you're just doing it every single day. And if it's $10 or $15 on average every day, that's per contract, then that's a win to me. And SPY is something that you can scale. So if I get the data collected and this count gets up to 50 or 60, things are still holding steady, it's the SPY. I could scale it to whatever I want, and still perform, theoretically the same. So those trades are going pretty well, though the one that we're looking at here is not gonna shape up. I feel this is this is my indicator that I made. It's not super scientific, but it just gives visual to. I took the trade at the white line in the middle, and then we gradiently get further into loss as we get away from that. And I don't know what happened. I guess it was FOMC day. I wasn't paying attention, and people didn't like it. But then we snapped right back, and I might have got caught up in that. Probably should have skipped today, but whatever. It is what it is, and that's why we take it every day.
Yeah. Can you flip back to your SOFI chart real quick? Yeah. So Viper, I want to just call out here because this is just a quintessential. So I see this type of chart so much in earnings, so much. And if it's not this, it's the Etsy chart that you also had, and it's that explosive move, just kind of that burning that volatility, that fire, and then everyone's like, oh yeah. Anyway, it's still reality, and you get this pullback. And then you can see it climbs off from there after that pullback. But I know the benefit of your strategy, the calendar strategy, is it works really well for smaller accounts. And so I don't want to discount that at all. If you go back to my comments on the calendar strategy, I think it's beautiful for that because it's a defined risk trade. You're not going to eat up tons of buying power or anything like that. But I want to, this trade right here is the type of trade that strangles just absolutely eat up and thrive, because you'll put that naked call on the call and the naked put on there. And yeah, you get real nervous the first couple of these that you do on that call side. And I'll tell you, it is the most uneasy feeling that you'll come to, because on the call side, your loss can pretty much be infinite because there's no end to how high a stock can go. And your account will eat up a lot of buying power on that breach of that strike. But continuously, I see time and time again that reversion to the mean. And as long as you size your strangle correctly and you're prepared for that buying power expansion, that is what makes just huge profit targets from the strangle. So I'm not saying switch over to strangles, but I'm saying this is a wonderful example of that reversion to the mean that happens again and again and again, and doesn't stay in the mean. It reverts to the mean and then carries on.
Yeah, absolutely. And honestly, this I should consider the strangle, especially like in this SOFI scenario here, and specifically because the underlying itself is not super heavy. This was 20 when I opened the trade. We were at $21, and so yes, the risk is infinite on the call side. However, if I do one contract, just to put some numbers to it for people, the risk is infinite because you owe somebody potentially the difference of a breached call. You owe somebody whatever that difference is from the strike to wherever the price is. So on a $21 underlying, if this thing went to $31, that's potentially $1,000 hit If that got called away, if that got assigned, right away. But that's part of the risk mitigation. That's part of the risk acceptance. And, a $31 move on $21 here, we're talking, math is hard, a 50% move. And so is that $1,000 hit or $2,000 hit? It was a 100% move. That's also sort of the math that needs to go into this, considering my account or an individual considering their account. It's important to view it as infinite loss potential, but also contextualize what's the price of the underlying, what is the path to infinity, what does that look like for the account. And then obviously on the downside, it's just assignment of 100 shares at $16, $1,600, that sort of thing. So I do think, to your point, that on these smaller underlyings, I should really consider still do all of the screening, because clearly my screener is calling out red hot scorchers. But it would be interesting to consider a strangle in this particular underlying size.
And for me personally, I didn't really start playing with a lot of strangles, naked strangles, until my account really crossed over 35K, 40K range, somewhere in there. That's where I got more comfortable, because like you're saying, that hit of that $1,100, right? Their worst case scenario, right? That's what you gotta protect for, that hit on your account. And you don't want that to be such a high percentage of a trade. And even then I was only putting on 1 or 2 strangles at a time. So it really is position sizing. But someday your account will get there. And it will be fun to do, and it will be scary when you get breached on the call side. I promise it will be. Several times it will be scary.
And I guess as part of this experiment of this new brokerage account, for the viewers' benefit, I loaded this account with $1,500. So right there, that's a no-go on any strangle at $1,500. That's potentially blowing up the entire account. It's not my entire. I borrowed from another portfolio to load this up, but that was the point of I wanted to run, and I didn't really state this clearly, but I wanted to load this account with a smaller size, so $1,500, and then see how cranking the SPY trade, the daily SPY trade, and cranking earnings with the calendar spread, where can I take that $1,500 and kind of simulate, but also actually benefit from simulating that smaller account size.
Well, that brings us to the end of this week's episode. Like I said, we're deep in the earnings season, so I encourage you to go to our Discord channel, link in the description below, as I do post the earnings trades that I'm targeting for the week before the week starts. So if you go in there Sunday night, it's usually there. If not, it gets put there a little bit later, but by Monday, it's there because I'm taking the trades. I make a little shopping list. I go out, I hit my trades probably around 10:30, 11 o'clock, my lunch break, and I fire those off for the week. And when you see my list, I don't actually tell you the strikes I'm taking. That's because it's almost always a strangle. So I will put the date of the earnings just for my memory. So I go to look at it the day after, even though I put all of them on Monday. And unless otherwise noted, they're all about 16 to 18 delta strangles. Otherwise, maybe it's a put or something like that, but you could adapt that to your liking. You could make them iron condors, which are defined risk. Anyway, encourage you to check it out. Encourage you to hop in there. Tell us what you like to trade. Tell us your favorite strategies. Love to hear to chat with you. Viper's things going well. We'll keep tabs on that as we go along. We'll be really excited to get more data points with that SPY trade. He's really starting to lock in quite a few data points, so that'll be good to have. So good luck out there. Have fun, and remember, think outside the block.